This conference will now be recorded.
Good evening, ladies and gentlemen. It's Clueless Trading Frank. It's approximately 9:03 p.m. on time, finally, on December 2nd, 2020. Welcome. This is our midweek strategic webinar. The last one was on Monday, a very precise and accurate forecast and predictive analytics that was delivered on Monday. And as you all know, these sessions are recorded, uploaded directly to the Clueless Trading YouTube channel for further viewing by all members, free trial subscribers, and anyone out there with the internet connection. Another quick reminder, roughly 20 to 25 minutes right after these sessions end, it's also directly uploaded to the real-time Twitter feed so that people can click and get an early preview of these very important strategic webinars that I do twice or three times a week. Welcome. Full disclosure, this is purely for financial education, not for any solicitation or advice. And let us begin. So it was a pretty monumental day, a very monumental day, no question about it. Not because just we had phenomenal winners across the board, reversal trades included, but also the fact of what the market did. And that's something that as traders, all of you have to understand the importance of. Today was what we call a classic technical bear trap. You wake up, you look at the futures last night, falling quite hard. You look early in the morning, falling very hard. I tend to check European futures around 3:30 in the morning. Sometimes, I just open my eyes automatically, and I'm right there on the iPhone. I'm like checking. I'm like, oh god, here we go. Okay. We did not have any short hedges in place aside from Palantir, as you all know, which was the only short trade that we had put out early last week, which actually worked out tremendously. I did sell most of it yesterday for a nice double, but had a little bit left on the put side because they were so cheap, which delivered almost 230% today. That's PLTR, Palantir. That's the only short trade we had. Mostly long positions, diversified, selective positions out there. So there we go. So you wake up in the morning, markets open down, God knows, like close to 400 points on the Dow. NASDAQ is falling apart. Tech stocks, which were looking higher, some of them earlier pre-market, like Amazon, all of a sudden just crapping down. So all kinds of stuff happens. So what do we learn from this? Because these are the days that we excel here at Clueless Trading. We're the masters of volatility trading. There's no question about it. There's no question about it. We don't freak out. We look at the charts. We look at the VIX that's right in front of you in the screen, which I'm going to go through in a minute. The volatility index. We look at the E-minis. We look at the NASDAQ futures. We look at the Dow futures and the S&P futures, and then we decide what we want to do. So the bottom line was it was a classic bear trap because the market opened down 400 and ended up. I'm talking about the Dow Jones. Ended up 60 points. That's close to a 400 to 460 point reversal on the market. That's like encompassing 2 or 3 days of sell-offs and a major rally within a matter of one day, within a matter of 7 hours, 9:30 to 12 to 4, 7.5 hours. Within 7.5 hours, you get almost close to a 400 point reversal on the Dow Jones Industrial Average. Think about that for a minute. Not to mention the S&P 500 and the Nasdaq NQ futures. This is huge. So it's a classic bear trap, and the reason behind that I put out on my Twitter broadcast, which I know all of you must have listened in the afternoon. One of the primary reasons was Salesforce.com. I don't want to go through it again because I explained it on the Twitter broadcast, so please feel free to review that. For some reason, the Twitter broadcasts, when I look at my desktop, don't show up there. I don't know why, but it does show up on your mobile devices, and you get to see it, and you get to hear it. So when Salesforce.com falls, $15, whatever the case may be, it fell, and that's a lot because that is a Dow component, Dow Jones Industrial Average component, and the stock was 241 yesterday at the close, and it fell to 215. That's a lot. That's close to 25 points, 26 points that a major stock, a multi-billion-dollar monster, 200 and well, by the end of the day, it was 200, close to 202 billion. That's a lot. Okay, so you have a lot of mechanical stuff going on the Wall Street side. They, large hedge funds who might have been long, which most funds are long. Salesforce.com, it's a very well-liked company. They have to adjust their positions. They have to sell a bunch of shares to come up with forced margin calls, blah, blah, blah. So it causes a ripple effect, which caused a big drawdown on the markets. There was really nothing that negative today, aside from the ADP payroll report, which was lower than expected, but that couldn't be the reason for this type of fallout when the markets open. So reversal days are fantastic, and it was fantastic because a lot of my members did extremely well today. In fact, some of them had their best day because they managed to scramble in on the real-time alerts and get into it and get into some multiple positions or even some selective, maybe 1 or 2 positions, and make a lot of money. Now, not everything was up, mind you. Not everything was up. There was still some red on the screen. Overall, I'm talking about. But the ones we were talking about on the selective tactical alerts, they're all beautiful. Remember, when a stock falls, let's say a stock falls from $100 to $90, okay, a 10% loss, and you catch it at that, let's say, no one really catches the exact bottom, but let's say you catch it at 92 and it goes up to $98 or $99, not even in the green. That's as good as buying the stock at $100 and it's up $8 from there, 8%. And imagine what the options do. So that's the way, as a tactical trader or as an options trader specifically, you got to look at it. Buying something cheap at the bottom of a flash crash, which really was what happened at the market open today. That's when prices are the cheapest. I know it's common sense. I know you all are grown men and women, you understand that, but the question is how many react to that situation. Most are frozen. Most human beings are frozen in the face of adversity. But here we are not. We react to it. We look at the charts. We look at some specific contrarian indicators such as the VIX, the VIX, and we decide to do what we do. There is an element of luck involved. There's no question about it. But luck comes when you act and you're prepared. And that's exactly what happened today. Classic bear trap, huge profits across the board on multiple stocks, all posted on the real-time Twitter feed, whether it was reversal on Facebook, on Shopify. Those are huge reversals. You're talking $20, $30, $40, $50, Amazon. Okay, and of course the smaller stocks like Uber and United Airlines and DraftKings, which move up from the bottom, $1, $2, $3, and that's a lot. Okay, so the key is that these are the kind of days that define real traders. And if you really want to be a real trader, which most people are not, they think they're traders. They're kind of like just, putting on the trader suit and say, oh, I'm a trader. But when days like today happen and then they act and they make some serious money, or at least turn their accounts around into the green, and that's what defines what a tactical trader is. These are not small words. These are important. It's coming from somebody who makes a living of U.S. financial markets. And just listen to what I'm saying, all right? Try to absorb what I'm saying. All right. So saying all that, one of the key things, let's dive into the charts here. I've got to keep this session a little bit short. I have something to do. So one of the things that first thing I look at in the morning is the VIX. Okay. So this was 9 o'clock in the morning, and I'm noticing that with the futures down that hard, I'm noticing that the VIX is not spiking right there. You can see the time at the bottom. Okay. I'm noticing that the VIX is not spiking. Here's 8 a.m. Futures are down, 200 handles on the Dow Jones and 50 handles on the NASDAQ. I'm like, there we go. Okay. And I'm noticing that the candles are still red. Here's when the market started, somewhere between 9 and 10, 9:30, right there. And immediately you start to see the VIX coming down. This was the VIX at 3 p.m. and this is the VIX at the close. So this is one of the first things, I look at a lot of stuff, but this is one of the things, a critical component, because the VIX, or the volatility index, is, and you can look at the volatility futures right in your iPhone, on Thinkorswim, or whatever platform you use. And I'm noticing you're not seeing a big number, big green number on the VIX. So there's something going on here. And that is that it's a positive divergence. Market futures are down a lot, but VIX futures are not up a lot. In fact, they were up a little bit. So very interesting. So that tells you something is going on there, which is a positive divergence for the markets. So nothing really, nothing there to see. Otherwise, we would have seen a candle like this, huge, in which case we would be hitting the downtrend line, in which case that would connotate there is danger ahead right when the market's open. Small tricks of the trade, things you can employ yourself. You can just check it right there on your iPhone or mobile device. So the VIX candle's still red, markets open up, and starts to pretty much turn around within the first half hour. No guarantees. There are no guarantees on this. But selectively, I walked you guys through the whole process today. Today is a great learning experience for a lot of traders, novice and advanced traders, of what a bear trap and what a reversal reflex rally, as we call it, off the bottom of a flash crash can do for your P&L. Exactly. So please use today as lessons to become a money-making machine, in my opinion. Because days like today don't happen too often. It does happen, and we have been very good at catching these things, but there is no guarantee that the markets wouldn't fall another 700 points. I mean, sorry, another 200 or 300 points. But the charts told us what the supports were. We're going to look at it. I've showed you guys throughout since the morning, since 9 o'clock, where the supports were, and it hit exact support. I'm talking about exact support. It's almost like a magical crystal ball, a technical crystal ball, and it bounced exactly off that. And that's why it's very important to track the real-time Twitter feed, because it's all there. So there we go with the VIX. This is where the VIX is. It's overbought. That's another thing that I noticed, and it was overbought yesterday. The VIX on the slow stochastic, which is more of a reliable indicator on the swing side, is overbought. You can see that very clearly right there. Okay, and despite the fallout this morning, it wasn't shooting. It remember, something can stay overbought. It can move sideways, but it didn't. It was still slipping. So that was my first indication that, okay, we're going to be fine. We'll be able to scale into some lows and buy stocks at some bargain basement prices, selective stocks at bargain basement prices, or you could buy the SPY at bargain basement prices and the other indices. So that was good. That was a bit of a relief. So it's overbought on the swing side, which is more the intermediate side, which is what we call the S stock, and on the regular fast stochastics, the F stock STOC, the fast one, that's overbought too by the end of the day. And it was overbought by the time the markets had opened and still trending down. That's what we call a positive divergence. It wasn't spiking higher. It was actually slipping while the markets went down. All right, I don't want to hammer that point anymore. And this is what the VIX looks like on an intraday basis. This is what the VIX looks like on a daily basis. We do have a falling wedge on the daily. Like I said, you got to keep things close to your vest. Technicals on the front end look fantastic, but I always keep an eye on the VIX. You could be driving 150 miles an hour on the highway, but you still got to keep an eye on the rear view mirror to see what's behind you. Exactly. But you still got your focus ahead. So that's exactly what the volatility index does. We got to look at the rear view mirror and say, okay, what's going on? Is there another crazy guy coming right behind me, driving crazy? That's the volatility algos. Or are we just, so this is what it is. So I'm keeping an eye on this because this is a bear flag, but it is also a falling wedge. And we are quite oversold on the daily. So that's telling me that at one point, don't know exactly when, we might, at one point, I would say, give or take after the first 5 or 6 trading days of a new month, which I've mentioned thousands of times, hundreds of times at my service, you always have the first 5 to 8 trading days, not calendar days, where you have the new institutional money, the pension fund money, the 401 money managers, 401k money that comes into the market by the institutional money managers. That's when they deploy money into the market. So if we do a calendar, if we do a day count, the first 5, 8, let's say 5 trading days is 1, 2, 3, 4, 5. It ends on 7th, Monday, and 8 trading days brings us to the 10th of December. So 7th of December to 10th of December is when I say the market's kind of top. And then comes the middle of the month. It's standard procedure. You guys have seen it hundreds of times. Give or take a few days from the 15 plus minus 2 or 3 days, you get a sharp reset or pullback. Always happens like that. Literally always happens like that. No question about it. And I think it's the same thing that's going to happen. So we still have a couple of days of a sharp move. I mean, of a reflex rally continuation, as we call it. A couple of hundred more points, and then you're going to get a pullback. And that's natural because you get overbought. You have to get oversold before you move forward. But I still believe that by like I said, that day count, either by the 8th of December or by the 15th, not the 15th, I would say by the 8th of December and the 11th or the 15th, between 11th to the 15th, you're going to get a sharp pullback on the market. And then we have the 3rd Friday of the month, which is the 18th of December, and that's monthly options expiration. I've mentioned it before hundreds of times. I'll say it again. That generally is a bullish event, at least a couple of days going into the monthly options expiration, which is the 18th of December. And this is, I'm talking about the broader market. And you should get a move up, a reflex rally again after the pullback that generally comes, or what we call resets, that generally comes in the middle of the month. So no rocket science there, just telling you what's worked, and that's the way it is. All right, now here is what the overall market looks like. This is S&P 500. Now keep in mind that this is very much, and I've mentioned this repeatedly over and over and over again. Please, there's a difference between hearing and listening. Absorb the knowledge that's been thrown out there. I'm not the most knowledgeable person. I'm a very passionate student of the market, but I'm just sharing with you things which have worked very, very well. Keep in mind that this is and I've said this before many times, this is a stock picker's market, period. It's not a stock market, it's a market of stocks. You could have the market up at 400 points on the Dow, and you will still see red on the screen, and you will still see a bunch of stuff that's still green. So it's a stock pickers market, so stay selective. I try to be as selective as possible. I don't have huge manpower of 10, 20 people working for me. Neither do I want that. Where I'm spewing out, dozens and dozens of stocks. All you need is 1 to 3 stocks which do extremely well to make you a lot of money. Not necessarily every day, but let's say every week. All right, that's all you need. You need 1 or 2 total bangers, like boom, explosive movers. Whether it's coming off the bottom like a reversal rate like today, or something that just takes off, and you're golden. So you don't need to be in like 30 different things, even though diversification is good if you have the ability to manage those trades, and if you have the ability, and if you have the capital. So saying all that, this is what the overall picture looks like. Still a bullish picture. A technical chart, keep in mind, has to do with cognitive bias. What does that mean? That means a bear, somebody who's bearish on the markets, U.S. financial markets or stocks or market overall, will look at this in a certain way and interpret it in a certain way, and somebody who is bullish or has a more optimistic view on the market would look at it in a certain way. So a bear will look at this and say, "Oh, look at that! That's a rising wedge. We have a major resistance here. Look at the MACD. It's starting to kind of flatten out, even though the stochastics are the MACD histogram has plateaued, and then it's kind of moving sideways on a flat level on the lower end. Even though the stochastics are the percentage K and the percentage D lines are looking fantastic, they'll look at this, the stochastics, and they will say, hey, look at this, it's going to break down. Well, that's the bearish point of looking at it. There's a lot more than just looking at these two. One of the other factors that drove the market, even though the news came out later in the day and propelled the markets higher, it looks like the Democrats and the Republicans are finally getting together in some sort of compromise on the stimulus bill. I mentioned that too on my Twitter broadcast. I put that news out there also. I actually put the news out there before it showed up on CNBC. All right, and that's a big plus. That's a big plus. Whether they compromise on 500 billion, 600 billion, or 900 billion, it's still a plus for the overall markets to get a fiscal stimulus bill, which will provide more liquidity for the U.S. consumer and for the overall economy. So that's a big plus. Then we have the seasonal factor. Then we have the institutional money coming in the first 5 to 8 trading days that I mentioned to you. So there's some tailwind here, not headwinds, but tailwinds. And then we, of course, have the vaccine factor. The vaccine things are going to be, there are massive amounts of vaccine being delivered in the major states across the country. And looks like by the middle of December or so, you actually get the first vaccines available for in the U.S. and for people to be vaccinated as they choose to be, and that's a big thing. So the reopening trades are fantastic. So going through that, this is what the daily looks like. So it says from the bearish standpoint, this is actually a very bullish chart. I've been talking about this for a while, and I've been dead right on it. No question about it. Okay, so let's look at this. Draw this out a little bit. We have a massive, I'm drawing the broader picture, W pattern. Here's your neckline. Here was your first neckline, second neckline. That's a W pattern known as a W dragon bullish. Absolutely fantastic. And that goes all the way to September. You can also look at this as a cup, a handle, bang, break out of the handle, and a continuation pattern. So once you get to the top, which was November 9th, when the markets opened up 1,000 points on the Dow on November 9th, obviously when you get there, you're going to see some sell programs, and that could be on an intraday basis. But looking at what we see, when you take in the weighting of these two patterns, the W pattern and the cup and handle, I would say that there is a high probability that we break out towards new highs. That's when you do your major selling. And that move up, like I said, could be anywhere from 300 to 500 points, bringing us again over 30,000 plus on the Dow, which is obviously a headline number that makes all the news. And once you get towards that, that's when you want to start loosening up on the long side and starting to look at some short hedges. Don't try to hedge too much and buy too many shorts through the different instruments that we use, whether it be SPY puts, QQQ puts, or any of the ETFs, or shorting an individual stock. But at least you should be contemplating that once we break out. Now, what's the maximum move, what we call max upside? Well, I can only guesstimate that by looking at what I've drawn. Here is your acceleration channel. If we break out hard, here's your upper Bollinger, 3691, call it 3700 on the S&P 500. We closed at close to 3669. After hitting 36 on the S&P 500, we hit 3671 almost. And max upside would be this acceleration channel, these two dotted lines, and that would be 3752. So if we go to 3752, that's almost 80 handles from where we closed today. So 80 times 8. So you're talking roughly another 600 points on the Dow, which can be had between now and the middle of the month. Of course. Otherwise, we hit this top here, we overshoot towards upper Bollinger, and nothing goes in a straight line. We know that. We shoot up here, and then again, we do the same routine. We pull back a couple of 100 points. This is your acceleration channel, and then we bounce again. So it's all in these type of structured charts that I put across, and this is what I rely on, plus all my information and knowledge that I have, and a lot of it also has to do with gut feeling. If they're doing this for a long enough time, after having worked on Wall Street for many, many years, after understanding how the money managers think and institutional money is managed, which most traders don't understand at all, okay, it's not their fault. I believe that that's probably what's going to happen. And if we break down, there's your support right there, the red line here. Next, let's look at a short-term picture. Now, these charts are all shown to you guys during the day, so I'm just taking the time to explain it to you now again. Let's clean this out. Now, the other factor that is propelling the markets is the $4 to $5 trillion worth of cash that's lying around. One of the things I haven't had a chance to talk about recently is the 10-year government bond deal. The 10-year government bond deal is right now at 0.948%. Now, without giving a long-winded, Princeton economics, Harvard economics explanation, the fact that bond yields are going higher means bond prices are going lower. In simple English, money's coming out of the fixed income, safe haven, U.S. Treasury bond market into the stock market. And that's a big plus. That's a big plus because bond deals were about 0.5%, 10-year government bond deals, which is a major benchmark, was like 0.5%, 0.6%. So it's up almost 50% on a percentage basis, the bond deals from 0.6%, let's say, to 0.95%, more than 50% just in a few weeks. So as bond deals go higher, bond prices go lower. Simple. That's the way it works. Okay. And if bond deals are going higher and the bond prices are going lower, that means there's more selling happening in the fixed income market. You might have heard that in the news. I'm just explaining to you in a very simple, the KISS version, keep it simple, stupid version. So where's that money going? It's coming into the stock market. It's coming into the stock market. It's not disappearing, in thin air. So that's another big plus. That means inflation is going to pick up. And overall, that means the U.S. economy is starting to get stronger. And with the vaccines coming out, finally, you have the U.S. economy starting to breathe better. So that's a big, not headwind, a tailwind for U.S. stocks to go higher. So keep that in mind. Now, the sentiment factor with traders. There's a lot of There's a lot of traders. They'll look at it. So look at that. Everyone's bullish. No one's bullish. No one's bullish. The bulls are talking the talk, but not doing the walk. Ask yourselves when you listen to me tonight. Are you bullish? Yeah, you might feel bullish because you had a couple of good trades, but are you really playing offense? I don't think so. I'm not even playing offense. I'm doing really well, but I'm not playing offense. I'm not putting all my chips on the table and said, that's it. I know it's going to do it. No, I'm playing staggered profits. I'm selling sometimes a little bit too early, not too early, but early. So I'm being cautious. I'm being bullish, let's say to 60% of my peak performance. Ask yourself, are you being bullish? Most traders, and especially retail traders, they're all trading scared. They're all saying, oh, I made a little money here, not all, many of you are. I'm making a little money there. Well, what about making the big money? Exactly. So from a sentiment standpoint, regardless of what you see out there is no extreme bullishness, period. It's all fake news. When you look at, bullish sentiment is at 70%, bullshit. Because all you have to do is look at yourself in the mirror and ask yourself if you're playing offense or you're playing defense. And I bet you the truth, not the lies, is you're playing kind of defense. And, putting in some money and making some money. You're not taking size trades that will delivering you 100, 200, 70, 80, 90, 300% like a lot of my alerts are. You're not. And if you're playing small. That's fine. There's nothing wrong with it. But I'm just showing you from a sentiment standpoint, nobody is really bullish. That's when markets top. Whether you're, guys on stock tweets yelling and shouting like monkeys on a hot tin roof, and of course a lot of smart people there. I always, check stock tweets for a lot of good information. But most of them are just like chirping away. All right. So bullishness, in the true bullishness, is not there in the markets, neither from institutions, the big money, not the hedge funds, and certainly not the majority of human traders. I've been dead right on this market. Am I like waking up every morning and say, that's it, the market's going to go nuts? No. So if a person like myself, who is been dead right on the market and on majority of individual stocks, is not completely in the bullish camp, then how can somebody define and say, oh yeah, everybody's getting bullish? Because that's when you get market tops. Just want you all to understand this. All right?
Frank.
Go ahead, sir.
Yeah, the put call ratios. It's a dead giveaway. Call
go
ratio
ahead.
5.
Yeah, go.
And then take a look at something like VIXI or UPXY.
So what? Okay. So what about the put call ratio? Where is it now? Like around 0.8, 0.6?
Well, on the VIX, on the volatility products, they're pretty low, like 0.2. You look at SPY, it's like 1 point something, I think.
So if it's 1 point thing, so that's a contrarian bullish indicator. Do you understand that part? Do you understand how to read the put call ratio?
Well, it means there's a lot of puts.
That's right. So that means they're going to get squeezed just the way they got today. It's a bear trap. When the put call ratio drops down below 0.4, that's when you know that overall sentiment is getting a little too bullish. Do you understand? Do you understand what I said?
Exactly.
Exactly. So the good point that Chris brought up, so all of you can learn from this. When the put call ratio drops, and I also look at the call put ratio. You can get all that from the CBOE, Chicago Board of Options Exchange. So when the put call ratio dives down to horrendously low numbers like below 0.4, that means there are 4 puts bought for every 6 calls that are being bought. Okay, which means people are getting a little too happy. And God help us if it drops to 0.2. That means for every 2 puts, there are 8 calls being bought. So that means the markets are topping because everyone's a little too happy. But then you have to look at the different put call ratios, whether it's institutions, whether, what sectors and blah, blah, blah. Don't worry about it. But generally speaking, if it stays at 0.6, 0.8, that means for every 8 puts, there are 2 calls being bought. And that's pretty much where it is right now. So there's a lot, believe it or not, there's quite a bit of hedging or put buying that is going on in the market. And that's the reason you have these monumental bear traps like we had. Well, one of the reasons, monumental bear traps, because nobody is really bullish and the majority are kind of bearish. And that's exactly what I was explaining. So let's move on to this chart here. This is a great representation. This is the actual S&P 500. This is not the futures. And you can see here it's a rising wedge. Max upside on the upper end of the rising wedge, believe it or not, is close to 3,736. Upper Bollinger, which I think could be short-term max upside, is around 3,700. And just the overall pattern of this chart is pretty damn good. Stochastics are overbought on the hourly, and they also, they reset and then they go higher. We have seen that happen on my next chart. I show you guys all the time on the E-minis. They're always getting overbought and oversold, resetting. So this is a ascending triangle right there. Now remember, you can look at patterns, but you also have to look at the internals. But looking at the external pattern, this is an ascending triangle. Juice is on the upside right now. The risk is actually on the upside, which means that the bears are the ones, the shorts are the ones who have to be careful. Because if I was short the market in a big way, which I'm sure many hedge funds and many people were, not our people, but people out there, they got creamed today. I mean, part of the reason the markets went positive, reversed almost a 400-point drop on the Dow. S&P went positive. NASDAQ went positive and then ended kind of flat, is because of these billions of dollars that were shorting the market. So there we are. Then we have a micro triangle right there. Look at that. And this is the zone of, this is the short squeeze zone right there. First level is this. 2 was 3,700. Max level is this. And if the market crosses over and hits that 37.25, 37.50 mark, that's when you get in like maximum technical bullishness. You got to be careful at that point. You have to be. And Boeing alone can take us there, which has been one of our best winners, swing trades. Phenomenal. Boeing has a gap, which I'll show you, and I've showed the chart before, somewhere around 240, 250. If Boeing goes to $240, the 15 points from here, right there is a whole bunch of hundreds of points on the Dow, because it's such a major component of the Dow Jones Industrial Average. And it picks up and brings up all the other aircraft suppliers and everything too, and the airlines. And as you know, the Boeing 737 MAX certification has been approved, and Ryanair and other airlines are starting to buy 737 MAX. In fact, I put a fantastic video out. Chris, you probably got a chance to see it. I actually recorded it directly of the TV of the first test flight, not the first test flight, but the actual test flight with reporters and real passengers that took off today. Did you see that? I put it on the Twitter feed.
Yeah, I saw it.
Yep, exactly. That's big stuff. That's big stuff. All right? That's huge. All the pissheads said, oh, Boeing, that's it. They're never going to fly the 7. Bullshit. I always stood by it. It's the finest, one of the finest American industrial companies ever. Not just American, worldwide. Everybody loves Boeing. Everybody. From here to Timbuktu, the Iranians love Boeing. Okay? All our enemies and friends and everybody loves Boeing. They just wanted the safe 737 MAX. And they have done everything. Now they're getting certified. Europeans are going to buy more Boeing planes. What can I say? I've been telling you guys to buy Boeing between 140 and 160, and the stock is at 230 bucks almost. So I have nothing to say. So saying all that, that's it. Max upside here. And of course, we know what the downside is. Here's your support. And this is what I was looking at. I was looking to see if it would close this gap, and it did close the gap exactly. Now, this is what I said about the crystal ball portion of these charts. Because I saved you a lot of money instead of freaking out. And I'm sure some people freaked out this morning and other days. So here we are. Here was a gap. See that gap right there? Here's another gap. This is the actual gap, actually. This was the breakout level. And guess what it did? Can't get any better than this when it comes to charts. Right there. Guess what it did? It kissed it exactly where the line was drawn before the fact, not after the fact. And then created a nice bullish hammer. And I was expecting it, believe it or not, the way things were going this morning, that we could come and retest this uptrend line and this lower gap right here, the actual gap that was 36.25. I was prepared for it. Because by that time, things had been very oversold, but it didn't. It didn't. It came, kissed this line, and then did what it did today. Right there. That's the S&P. So this is still a good-looking chart. This is the we still have like I said, there's always risk in the market. Could be anything. This stimulus stocks could be completely thrown out of the water. Boom, markets can drop 300 points, 400 points, easy. Even though we are getting some good vibes coming in from the Dems and the GOP. So pattern looks pretty damn good, but these are the levels we're watching for just in case we break down. Next, this is the daily active traders chart. A beautiful cup and handle. This is what we were this morning at 7 a.m. right there. And guess what the markets did? This line was drawn from 2 days ago, the support line. Oops, sorry. And guess what the markets did? This was the lows at 9 p.m. yesterday, 9 p.m. after market. This was the lows that the market tested at 7 a.m. today. And then the future started to go. So that's your major support level here around 36.44. Some of you who are more technical traders, these things matter a lot. It certainly matters to me. So this way I can help myself and I help guide you guys so you guys can do what you need to do instead of just panic sell or do whatever silly things that human traders do. So this is where we are right now. Overall pattern is still a cup and handle. And this is a very bullish move. This is a 1 hour chart, not a daily chart. We actually turned around. That's it. Now, let's take a look at something we call the McClellan oscillator. Now, the other thing is I'm pulling the McClellan oscillator, just mentioning this. The other thing that is that from a sentiment standpoint, that when I say that nobody's really bullish, nobody's making the money that they should. I'm doing very well, but I'm not making the money I should. Could have made a lot more. But every day, try to get better. And the another evidence of that is on a monumental day like today, where huge profits were delivered on multiple trades, whether it be Shopify or Amazon reversal trades or the overall market or Uber or Lyft, all our trades that we put out there, Boeing, just to name some. After hours, we have Okta, which is up $20. There is no real excitement. And why do I say that? We only have one person in attendance right here, and that is Mr. Cristo. Exactly. One member in attendance. I know it's a Wednesday and it's it's winter out here in the East Coast, but there's one person in attendance who is actually at this strategic webinar. You always have to look at the overall picture. So there is no real excitement, even though I'm getting a lot of feedback from members. And I'm talking to you guys as I'm setting up the NIMO chart. It's not like it's a packed house with 10, 20, 30 people saying, hey man, what's the next stock? Yeah. Because a bunch of people, for their fault, not mine, never capitalized on what happened on a day like today and many days like today. That's exactly what I'm saying.
I love these days.
I'm sorry, what was that, sir, as I'm setting up this chart?
Oh, it reminded me of like a couple days in August we had. It was just a total melt up day. It was great.
Yeah, because I always say, Chris, that bull markets and bear markets have one similarity, and I've said this many times on my webinars. From a psychological standpoint, from a behavioral finance standpoint, they're equally hard. Why? Bear markets are hard because you buy something and it's slipping down. And you're like, God, should I buy more? And then bang, then it hits down more. And bull markets are just the opposite. You don't buy, it goes up more. You're like, should I buy it? It's like stretching out more. And boom, it goes up more. You're like, oh, I missed it. Boom, it goes up more. So that's why days like today is a gift, because you could get some bargain basement prices on certain things on a short-term or longer-term basis and make a lot of money. So that's why I always say bull and bear markets from a psychological standpoint, from a trading standpoint, are exactly the same. Melt-ups and meltdowns are equally difficult from a trading up standpoint. People think that, oh, it's a bull market, I'm making a lot of money. No, you're not. In fact, you're too scared to get in because you can't believe the markets can go up more and more. And that's why I try to explain things in very simple black and white type of in a black and white type of explanation so people can understand it. So that's, yeah, you're right. So melt ups and meltdowns are equally difficult. It's just, the average trader out there cannot make money on a meltdown, because every time they're trying to short something, the market goes up 200 points against them and then it falls again. And the melt up, they're like, no, I can't chase this. And the dips are so shallow, like today, for example, and they turn around so fast that they don't react. So in both ways, they're not really making any money. So that's why I would say you got to be kind of technically inclined to take advantage of what's going on in front of you. All right, let me try to set up. I haven't actually seen this one tonight. So this is the NIMO, a very good strategic directional bias signal on what is happening with the markets. Let's see here, simple average, Bollinger. I know many of you have seen this. I show this quite often. So in essence, what I was saying was there are no perfect moments. You just got to take the moment. I know it's kind of a cliche term, but it is a fact, and just try to make it perfect. Whether it's short-term trading or longer-term swing trading and stuff, whatever, you got to make money while the markets give you a chance. And the markets only give you a chance to get cheap prices when you get quick, sharp pull downs. So if I get another, let's say 500 point down and the technicals are not broken, then that's going to be another gift. So because the markets keep on going up 400 points every day, yeah, I'm going to have selected positions and stuff, but I am not going to be piling in like crazy on a runaway market. And that's why I'm so particular about taking profits and looking at my charts to see at what levels where the supply or the sell programs come in. I'd rather see a down market where I can buy in cheap when nobody wants to touch it. For example, this morning, just one example, and there have been many other examples, and that's what I like. Buy low, sell high. But that doesn't seem to be the case, even though everyone's like, oh yeah, you know, it's so simple to do. It's not. So this is your NIMO, which is very interesting. So the way you read it is you're looking at these histograms here. Let me just get there. And just like you, I'm looking at it for the first time. This is where point of maximum danger. This is when people are starting to feel a little too happy, right there. Okay, when it gets into that 50, 60 range. We're only at 28, and it looks like it wants to head a little bit higher. And if it does go to 60, that means that's when the market gets into that upper end of the zone, into the mid 2700s on the S&P 500. Can happen. We shall see. So this is certainly not overbought. We do have it winding down a little bit, bending down a little bit, the MACD, but at the same time, the histograms are very shallow. So what this is telling me, this is from years of tracking this chart and trying to understand, read the tea leaves. This is actually like reading the tea leaves in the market. I expect that this one will start to move up within the time frame that I showed on the calendar days going into the middle of the month. This is getting quite oversold. So once the full stochastic starts to turn, you can expect the markets to get another couple of hundred points. So this is quite oversold. And if it does start to turn, you're going to see. So this is actually, let's put it this way. This actually looks pretty damn good. The RSI is at 50. RSI, when it comes in close to that 65, 70 level, is when things get quite overbought. But looking at this picture here, these are the maximum points of complacency. People are starting to feel good. They come in and no good. Also keep in mind, like I said on my last webinar, we have a lot of tax harvesting, tax loss selling, tax adjustments, all that stuff that happened on the middle of December, right? Exactly. So that's another reason why the markets basically have some selling pressure. So this is pretty good. And when it gets down and crashes and nobody, you know, there's like literally nobody who wants to touch the market. Every other great mind on TVs like that's it. The market's, you know, on a bear market right now and all that garbage. Some of them are still saying it. It's amazing. That's when it hits these low levels and literally hands down buying. Hands down buying. This has a 90% probability, literally a 90% probability you get massive, massive reflex rallies. You're talking 1,000, 2,000 points once it hits these levels. And the same thing, you get 1,000 plus pullbacks once you hit the upper end of the level. Very easy to understand. This is your daily chart. Let's take a look at the weekly. Wow, the weekly is looking pretty damn good. Kind of choppy, still at that 28 level, but you do not get overbought unless you cross over 40. So we're not there yet. Okay, so it's still in that zone where we still have some upside room. Look at the MACD, beautiful. Look at the full stochastic, certainly overbought, no question about it, but still hugging around the 77, not fully overbought, which is around 80 when it gets up here. Not there yet. So even the weekly chart is saying, hey, we have still some room to move, and that totally matches what I explained on the earlier part of this session with how much the markets can move. So far, these directional bias indicators are saying It's okay short term, but we're going to get some turbulence towards the middle of the month. Very simple. All right. Stocks. Let's look at stocks. We covered the VIX. We covered the overall markets. Let's look at the QQQ. Where is it? SPX daily. Let's look at the. So here's the QQQ. Your NASDAQ 100, which primarily has to deal with techs and biotechs, primarily techs. And just looking at this, looks pretty damn good. This is what the chart looks like. Told you guys the NASDAQ could hit a new high, and it hit a new high. And it's going to go up and hit a newer high. All right? It's going to hit a newer high. Because the big NASDAQ stocks haven't really even started making their move, even though they were up 40, 50 points from the bottom. And we did very well on it. Amazon was still down 20 points. Google was the one up 30 points. Apple was only up 47 cents. Netflix was down $3. Facebook had a big run up from the bottom, but ended the day down 5 cents. So you're not seeing like the whole tech sector move, but look at this chart. Look at this chart. There's your acceleration channel. Upper end of that on the Qs is 306.74, 307. People who like to play the QQQ calls, terrific way of playing the broader tech market. It's worth the buy. Where the downside, and this is again where the crystal ball charts, come into play. I was looking at this. I showed this to you guys this morning. Here's your gap. Guess what the Qs did? Now remember, these charts are drawn before the fact, not after the fact, right? So I'm not trying to match my charts with where the market happened. I show these before, so you guys know what can happen. So guess what it did? It kissed the upper gap, well, the lower gap, but the upper range. And this is beautiful. And then boom, there you go. So you could buy hands down those calls at $6, $7, $8, $9, which went to $30 or $20 on the Shopify's and the Amazons, which went from 24 down to 14. The calls, they're expensive. Yeah, 24 down to, they actually went to like 10. The 3250 calls yesterday were 25. They went to 12, and then they went to 26. So that's how you make the real money, all right? You don't have to wait around for 1 week to make that type of money. You can do it in 1 day and just walk away. But try it sometime and let me know how it feels. So right there, it touched the gap, almost came down to the lower gap, big hammer reversal, long tail. I put it out there, and it went up. You look at this acceleration channel. It's an acceleration channel because it's accelerating at a 45-degree angle. The upper end of this, I repeat again, is right here, approximately 307, and max 308. There's nothing here, at least externally, which is telling me that all of a sudden we're going to crash and burn. But anything can happen. Remember that. It's a very volatile market. Anything can happen. This is starting to ease back a little bit. That's fine. That's fine with me. And why is it fine? Because there's enough momentum and juice to do this. And this is my predictive analytical part. Right there. Okay? Let's see. At least I know what the bottom is. At least I know I can buy this move here down in that 299, 300 level. Well, more like 300 level. And if it breaks that, that's a different story. Then the whole pattern changes. But for now, it's fine. Exactly. What else? Chris, throw out a question, man, because I'm pretty much, I don't want to go through like all the stocks and everything. I put a lot of great charts out there today. But while you're talking, I'm going to show you Amazon, which I think has a lot of juice to move this month because a lot of big fund managers.
I was going to ask you about Google.
Which one, sir?
I was going to ask you about Google.
Yeah, I haven't actually. I have Google's chart drawn on my other screen. Why did I put this? I must be tired. I typed in Google.
Yeah,
So
it looks
this
like
is
it's started to break out today, and I think it will.
yes, yeah. No, you're right. It actually broke out today. Period. There's not no, and it broke out. So let's erase all drawings. So this is Google's picture. I haven't traded Google in weeks now because I've been doing really well with Shopify and Amazon and Netflix. So I haven't really good that you brought it to my attention again. All right, let me see. Pen color. 1 second. So this is Google's chart going all the way back to February of this year. This is a full scale breakout. Google, just in a very simplistic manner, and this chart was drawn, a while ago, obviously. Upper end is 1900. Google wants to go to 1900. There's nothing here wrong with this chart. Absolutely nothing. Okay, all good. Volume's great, and the overall pattern is dictating. Now, short term, intraday, Google can be down like 13, 14, 15 points. That's something that traders you have to deal with. But if you're looking to swing trade this stock for the month of December, I would everything points towards 1900 and a possible breakout over that. So you got about 80 points on here. So that's the answer on Google. On the same note, let's take a look at Amazon. Now, I find Amazon to, in my opinion, given the seasonal factor, everything, holiday, internals, all that stuff, and the fact that it's not at its old highs yet, find it to be a more lucrative swing trade as well as a day trade. Okay, so here's Amazon. You have a you got this huge move throughout the year, starting in February. Of course, ups and downs a lot, but still, give me the broader picture. And then you have a consolidation channel right here. Big swings, it's a big stock, it's a big boy stock, so you move around big. That's 800 points, 80 points right there. What am I saying? 80, 2,700, yeah, 80 points, yeah. And this is where we are right now. So I feel that Amazon is going to break out, and it's good for 3,400. I don't know if it's going to go to 3,500. Who knows? But I feel that 3,400 or 3,300, that's 100 points from here, ladies and gentlemen. The stock alone today on a 50-point or 60-point turnaround, it was as low as 31.73, went to 32.32. So 32.32. And as option traders, these things are really important. 31.73 was the low of the day on a 59-point move. I put that on my Twitter feed also. The options, the 32.50 that I told people to buy, went from $12 to 26. So you got more than 100% return if you look at it net from top to bottom. More than 100% return on your money, or even if you catch the middle, just in one day on a 59-point move. So imagine if the stock moves up 100 points, which I think it can do. I'm never going to say quite easily, but it's very feasible. So this one is to me more lucrative. I believe that 33.20, which is this downtrend line here. Let's clean this out. Right there. This is a consolidation channel. If you're looking, the big boys, the fund managers and stuff, they kind of look at these big pictures. Right there is 33.13 up. Clean these lines out. There you go. 32.87. That's another 80 points. I'll take it any day. And then if it gets up here, which was the last major sell zone for Amazon, was 3,500. I'd be more than happy to take 33.71 or close to 3,400, 200 points. So I like the stock a lot. Apple. Each chart will look different. Apple is range bound and attempting to break out, And these small moves deliver generally anywhere from 50 to 70 to 80% on your money. And you can see here, here's the upper end of the range, 125.64. If it breaks out, you got a gap here, and that gap fill is somewhere close to 130. So Apple, let's not get too crazy. I don't think it's going to go to 140 in one moonshot, but if I think it's got a very good shot, obviously, to go to 125.64. That's 2.5 points from here. Good enough for making 70% on your options. And if it does go to 130, that means you're obviously going to make quite a bit more. So this is, I hate using the word, but this is more of a safe trade because it's slower moving. And unless Apple comes up with something really like out of the world, you're not going to see it gap open $5, $6, $7. It does happen. We know that. But generally speaking, it gaps open $2, maybe $3. And of course, on reversal days like this, from the bottom up, you can make $2 or $3. That means you can make 60, 70% on your money. The 122 calls went from 274 to $4.10. So that means that's like buying a $27 stock that went to $41. Gotta think like that. It's pretty nice. So that's Apple. It's really a range play. Let's take a look at Netflix. Looking at the big stocks for a minute. Same story, very similar to Apple. And clean this out a little bit. These are all daily charts. And these are great trades. These are all great short-term trades. And you can really build an account on these type of stocks incrementally. Right there. Let's take this out. So let's look at this zone here, right there. So basically, it's all range trading here. This is 519, so it's got a good shot by middle of the month to go to, if the market does what we think it's going to do, then it goes to 519. Right there is going to be a big sell program. If it breaks above that, then we see what happens. Everything else is fine, but it's a range trade. Lower end of the range is approximately 475 to 480. Upper end of the trade is 520. It's really as simple as that. Really as simple as that. Nothing wrong with the picture, nothing that really exciting. Shopify. Now this is exciting, okay? It's not just exciting because I think the company is, great company. It's not just me saying that, because they're right in the middle of all the good stuff. So this is your longer term chart on Shopify, which I've explained it on multiple webinars. Those are the upper end of the ranges, but forget that. Let's see what is happening now, how you can make money now. So again, another range trade right there. Lower end of the range, 880. Oh man, I wish one day the stock, when I'm not in it. I sold it today because it hit exactly where I said it was going to go, 1080. We had the 1080 calls. And I said I would re-enter the 1100 calls, actually, sorry, bought small amount of the 1100 calls, but most of the bulk of the money that was made, the 1080s, gone because it hit 1080. It's amazing. That's why we bought the 1080. And the people who bought Shop with me a couple of days ago and even earlier on today, they're just losing their head. The 1080 calls were $18 yesterday. They opened at 10, went down to 670 on the big whoosh down, went up to 22, or to be exact, 21.63. So, told you guys to buy it. When I told you guys to buy it, it was around $8 to $9. You could have sold it all the way up from 15 to 21. That's called trading, ladies and gentlemen. Okay? And I walked you through the charts and everything. So saying all that, this thing is good for 1150. This is a far more higher IV, implied volatility. Delta, gammas, all that good option stuff. Options are not cheap, obviously. These are expensive stocks, but it looks damn good. And seasonally, it's in the right spot. Online shopping, big time. So this one, make a lot of money on it. Right there where it kissed it the other day, 1093. When I told you guys to buy, I actually told you guys to buy it around here. So this is a very good looking chart. No question about it, with a lot more headroom. 1100. And upper end of the range is 1150. Facebook. Very similar to Amazon. It's a, let's clean this out. Come on. So you got this big, all of them look pretty similar. I mean, this one's good for, like I said, 293. I'll take it. That's $6 from here. Upper end of the range, 305. Upper end of the channel, 312. 340, forget it. I'm not that bullish. When I trade Facebook, I'll trade it anywhere from $3 to $6 staggered profits. $3 to $6. Stock moves up $3, $4. Great. The options double. Sell, sit back, see how the stock's reacting, buy a smaller amount. You don't want to go in with the same amount. You're going to go in with a smaller amount. There's always a starter amount. So 295 calls that I told you guys to buy, they were around $3 the other day. They went to 5.5. It's almost a double on your money. Today you could have bought them at $1.75. $1.75. Told you guys to buy it, not at the exact bottom, but as we're starting to turn. The $1.75 went to $5.54. So 554 divided by $1.75, top to bottom, is a 216% ROI. Today, nobody catches top to bottom, but today alone, this small candle was 217% top to bottom on the options. So even if you caught half of that, you're a happy camper. So there's a lot of stocks that I can cover, but I don't really have the time for it. I'm just going to show Boeing. Where's my Boeing? Where's my Boeing? Boeing. Bear with me 1 second. Boeing's chart, I've already put it out there, but just showing you all again. There's a lot. There's a lot of ways you can skin the cat, but like I said, most people, regardless of what they're talking, they're just sitting in their butts, either too scared. It's great. It's actually great for tactical traders because the lesser amount of involvement in the market, the better off we are. We don't want everybody happy. Everybody happy means we're finished. Not finished. That means it's time to really like get out of the market or short the market and stuff like whatever. Okay, where is my Boeing chart? There it is. Boeing. Look at this chart. Boeing, one way or the other, will go kiss this gap here, this one. I have to go all the way back to show you. See that gap? That gap was back on March 9th, 2020, when it started to collapse during the COVID crisis too. So that's where this ellipse comes from, this oval, right there. This is, this is what I told you guys to buy, and bang, bang, bang. Very good looking chart. Yes, you'll have certain days when the stock's down 5-10 points, but right now a major overhang on Boeing, anyone can understand that, is out of the picture. The 737 MAX certification has been approved, and big airlines like Ryanair and others are looking to buy more 737 MAX, the new version of the planes. So calls are not that expensive. They're not that cheap, but they're pretty cheap, yeah, compared to the Amazons and stuff. So right there, So I don't quite understand why people sit around and twiddle the thumbs when they can buy stocks like this, which are solid blue chip companies with a lot of with a huge amount of upside. I'll show you the weekly. Huge amount of upside. I just don't get it. But then I'm not here to really delve into what people think. They drive me crazy. So let's see here. Draw. Like if somebody says, I'm scared of Boeing, I'm going to ask them a simple question. Why? The bad news is all in it. Well, God forbid another accident or so they find another flaw in the software. That's a different story. But just on the face of it, with what's going on, why are people scared of Boeing? It's laughable. What are people scared of United Airlines? The reopening trades, United Airlines, the Ubers, the Lyfts. It's kind of laughable. And United Airlines and Boeing kind of go hand in hand because they're all in the airline sector. So this is where it last peaked on June 8th. And that number is 234. So again, 225, 226 right now after hours on Boeing. 234. That's another $7. Take it. Once it hits there, of course, there's going to be some selling. But my feeling is that given the way things are moving, just externally, internally, as well as all the positive headwinds finally on Boeing, and every pisshead who was pissing on Boeing is now starting to say good things, because all I could hear was negative, negative, negative on Boeing. Like I couldn't, I used to joke around on my webinar and say, these guys, seriously. So now they're starting to gloss over and say, hey, Boeing this and Boeing is, finally coming around. Finally coming around. Dude, they were finally coming around from here. So now that the good news is getting baked in, you could go to 246. That's $20 from here. You got to handle intraday volatility. I understand that part. But net, it wants to go to 246, if not 235. What's there to seriously think about? Anyway, this is your short-term 1 hour chart on Boeing, still looking good. So let's take a look at the weekly. Now here's a weekly chart on Boeing. There's a lot of stuff here because we were trading Boeing quite a bit. All the way here, we were trading here. So forget all this. So let's clean this out. Draw. Remove all drawings. Beautiful. So this is extremely bullish. And let's draw this. 1, 2. Oh, this is nice. This was the first breakout. Second breakout. Just doing simple downtrend, uptrend lines here, ladies and gentlemen. Right there. This is your pivot, weekly pivot, very important. We're above that, very positive, very bullish. Once you cross over a pivot, that's good. It's always dotted in yellow dots. All this is fantastic. Look how it's surging. That's 4 weeks of intense buying, 5 weeks. Wow, internals are fantastic. Okay, and then we have a gap right there, right there. Gaps are always shown right there. Another major gap. Not even counting on that, okay? That's something that can happen down the road. Right here, right when it broke, I think that's way too optimistic. That's $325, but can happen. can happen by next year, early next year, right there. That's 326. But for now, 248, 245, like I said. Now, if you do a Fibonacci retracement, oh, you with me so far, Chris?
Oh yeah, this chart's great.
This is sick stuff, man. These are money. Okay, let's see here. There's your Fibonacci retracement going back to the top, which was $450. Let's put prices. So here's the prices, 367, 440, 450. Any sharp drop, any sharp rise, you know what the story is. You always somehow or the other, over a period of time, especially if it's a weekly chart, over a period of weeks, if not days, you get to the, over a period of weeks, I should say, from the bottom, you get to the Fib 50, Fibonacci 50. Okay. And it's funny, I talk about the fibs all the time, and then Kramer's talking about the Fibonacci queen. You ever heard some lady, I forget, she's some big shot technical analyst. She never comes on TV. She throws him the charts and he explains it. He talks to the Fibonacci queen. I'm like laughing. Good stuff, at least, you know. And where is the Fib 50? 267. It's going to get there. In between, we have 247, which is a downtrend line, this downtrend line. Once it breaks that, it's going to be a rush to 267. And right now we're here. We are above. We closed above the 38.2 Fib, which is not as important as the Fib 50. It's amazing. And these every 5, 6, 7, 8, 9, 10, 15 points is a lot of money for options traders. That's all I'm saying. You don't need this stock to go to 326 or 300. Just have to play staggered profits, $5, $6, $7, $8, and see your account grow. And anyone can afford to buy some Boeing calls. So showing it to you. This, if it hits the downtrend line, you're looking at 270 or 280. Can it happen? Sure, it can happen. One announcement from Boeing, or a couple of announcements that they got another 30 orders for the 737 MAX and blah, 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 with airline travel picking up, with the vaccination, you know, the vaccines and everything. People are dying to fly. Look at Thanksgiving. They were the highest number of people flying. Everyone gets tested before they get in, blah, 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 whatever checks. Dying to travel. People don't like staying cooped up. International travel picks up. Boeing sales go higher. Of course it can go to 280. So that's it, guys. Chris, thanks for attending. Kept me busy, kept my mind running. A lot of good stuff going on. A lot of good stuff going on. A lot of great charts on the real-time Twitter feed. And pass the word around. I always appreciate your shout-outs on Stock Twits. And let people listen to this stuff. It's simple, easy to understand, and a lot of good predictive analytics that we deliver here, and you know that. So take care. Have a great evening.
Thank you.
Anytime, sir. Bye-bye.